I know a lot of you out there are already investing in or have a strong interest in covered call buy right funds. So I thought it would be helpful to make a video just showing some of the dangers that you can run into when you invest in covered call buy right funds. It doesn't mean you can't make money, but these funds are unique and they have some issues that I think a lot of investors today just aren't aware of. It doesn't mean you can't make money, because you definitely can. But when you see yields of 9%, 10%, 12% and higher, you want to be careful because there are some dangers with these funds. To illustrate some of the issues that you run into with covered call funds, we're simply going to track the dividend and the capital in a number of covered call funds since inception from some of the largest covered call funds, Eaton Vance, Voya, and Global X. What you're going to see, in addition to the fact that the returns aren't so good, is that you have diminishing capital over time and diminishing income. I know a lot of you probably own JEPI and JEPQ and some of the others, but you're going to want to pay attention here. Those are new issues. They haven't been around very long. When we look at these illustrations I'm about to show you, I think this is what you're in store for with JEPI and JEPQ if you own them for the long term. Here's what happens when you launch a covered call fund at a market top. This is the Eaton Vance Tax Managed Global Dividend Equity Income Fund, EXG. It was launched on 2/23/2007. Bad timing. And look what happened if you put $100,000 into this fund and spent the dividend along the way. Your $100,000 is now $42,000. It's really difficult to recover from capital losses when you're distributing, say, 8 or 9%, and that's exactly the problem here. This fund was launched at a bad time. So I want you to think about JEPI and JEPQ. If we have a market crash in the future, JEPI and JEPQ will end up just like this. It'll be the same story all over again. Let's take a look at the dividend income stream off of this closed-end fund. Here's the distribution sequence for a $100,000 investment on EXG. Fund was launched in February of 2007. First year, $7,000 and change. The first full year was $9,500. That was the target distribution. And notice what happens circa 2010. The crash comes. Now the dividend's down to $7,650 and then $5,686 and just dropping like a stone. By 2023, your income was down to $3,318. That's a lot less than the $9,500 that you started with years ago. Here's the problem for EXG. The fund was launched right here in 2007, just before a major market crash. When you are making a high distribution on your underlying investments and then those investments crater, it becomes very difficult to maintain that distribution. And ultimately, your distribution is going to come down over time and your capital is going to decline, like we saw with EXG. My concern for JEPI and JEPQ is that we are late stage bull market, and if we see anything like this in the future, like the 2000 to 2003 or 2008 scenario unfold, then you can bet that JEPI and JEPQ are going to go down a similar path to EXG. Here's the Global X NASDAQ 100 covered call fund since inception in 2013. What a dog this thing is. If you put $100,000 in this fund and spent the dividends over time, today you're down to $72,000. And this is during a time period where the NASDAQ has done nothing but rip higher for the last decade. In this fund, your capital is going lower and lower. How is that a good investment? Here's the dividend stream for the Global X NASDAQ 100 covered call fund, QYLD. Starting with $100,000 at inception, you can see that there has been a high income, or a high distribution rather, because this isn't all income. Some of it's classified as return of capital. But there's been a high distribution off of this fund. The trend is down over time. This chart shows us total return for QYLD against a standard balance fund, the Vanguard Balanced Index Fund, and the underlying index for QYLD, QQQ. What we see is a depressing picture. Since inception for QYLD, if you had put $100,000 into the fund and just done total return reinvested, Today you have 240,000. It's the purple line. The Vanguard Balanced Index, a very basic 60/40 balanced index fund, would be at 249, and the QQQs, the underlying index for QYLD, would be at 670. Huge discrepancy, but when you can't even keep up with a 60/40 balanced mutual fund, it makes you question, why would you want to buy QYLD? Now, I know that there are people who think that these funds are a great income source, but if we get a serious crash in the NASDAQ, which we probably will in the years ahead, QYLD income stream, or the distribution rather, because it's not all income, is going to go down. In addition to the fact that your capital in QYLD is also going down. It's going to end up like EXG in the long run. Not a good long-term investment. And if you are a retiree and you're using this for income, you have no inflation protection whatsoever. Over time, both your capital and your income stream are going down. My opinion, you're better off in balanced mutual funds or ETFs. Here's another ghost from the past. This is the Voya Global Equity Dividend and Premium Opportunity Fund, IGD, launched in March of 2005. If you put $100,000 in and spent your distributions, today you have $28,000. Here's what happened with your distribution on IGD. Back in 2006, 2007, before the crash, you see a big distribution. $9,360 on your $100,000 investment made at inception, $10,000 plus in 2007. Then the crash comes, and look what happens to your distribution, going down and down and down. And by the way, look at the return in 2008. Lost almost 32%. Now that wasn't as bad as the S&P 500, which was down 37, but if you think you're going to get downside protection on your capital in these closed-end funds and ETFs like JEPI and JEPQ, you are mistaken. By 2023, your distribution off of IGD is down to a mere $2,400, a fraction of what you were getting 18 years earlier. I know that there are some people who think that these covered call funds are some sort of an income factory, that the 9% that you receive off of a covered call fund is the same as receiving 9% on the S&P 500 or the Russell 1000 or the Russell 2000. But let me show you the flaw in that thinking, because covered call returns versus long-term buy and hold in the Russell 2000 or 1000, it's not at parity, it's not equivalent. For example, in the Russell 1000, if you hold it for a long period of time, you're going to pay qualified dividends tax rate on your dividends, and you're going to pay long-term capital gains on your gains, both of which are at a low rate, a tax-advantaged rate. But in your covered call fund, a buy right fund, you're going to be taxed at ordinary income rates for the covered call option premium. Paying ordinary rates is going to be, for most people, a lot more than paying qualified dividend or long-term capital gain tax rates. So this is not an apples to apples comparison. The structure of the investment reduces your net after-tax return if you are doing this investing in an after-tax account. One of the big problems with covered call funds is that the high distribution often includes a return of your capital. Many retirees don't know this, and they think that the distribution is all dividend, i.e. income, and they end up spending it. They only figure it out once it's too late. In other words, once they figure out that they've actually been spending principal, and that is why their investment value has been dropping over time, it's too late. The money's not going to be replaced because they've already spent it. Here's one of the oldest covered call funds. This is EVT by Eaton Vance. In this case, you see that your $100,000 of capital is now worth $128,000 after all these years. The difference here is that this fund was launched at the bottom of a market crash in 2003. They launched this fund September 30, 2003. That's when it started trading. And it was almost at the bottom of the 2000 to 2003 slide. So the timing of the fund launch helped it have some success over time. By launching EVT, At the bottom of the market crash in 2003, Eaton Vance had excellent timing, and this timing played a role in the success of the fund. It's much easier to maintain the distribution when your underlying investment is going up in value over time. Compare that to EXG, which was launched at a market top and saw the investment value crater and struggle. Here's the distribution pattern on EVT. Starting with $100,000 in 2003 at inception, you can see that after the crash in 2008, the distribution did go down, but in later years they brought it back up. Also, I want to point out the huge loss in 2008, minus 53+%. If you think you're going to get downside protection in covered call funds, be prepared for the potential that you could exceed the losses on the index. By 2023, the distribution on EVT was back up to nearly 9,000, slightly ahead of your first full year's distribution in 2004. Overall, both your income and your principal are ahead of where you started with EVT since inception. So let's add it all up. Covered call funds can give you a very high cash flow in retirement, but that cash flow is not going to be taxed as long-term capital gains or qualified dividends. At least most of it won't be. The cash flow is going to be taxed as ordinary income. If you're doing this type of investing in an after-tax account, that's a big negative. And a high return or a 9% type return on a covered call fund will not be the same on an after-tax basis when compared to traditional qualified dividends and long-term capital gains on ordinary investments like the S&P 500, the Russell 1000, etc. Over time, your investment in a covered call fund is likely to diminish. Your capital base is likely to be diminished over time, and your distribution is likely to come down over time. Mostly this happens because of return of principal. When you're getting the distribution, a portion of your distribution, what you're calling a dividend, is actually just a return of your money. And for many retirees, they don't realize this until it's too late. They end up spending their principal and they don't know it. Don't let that happen to you. The covered call fund may be an income stream that could fit in between traditional bonds and stocks, but I would not overweight your portfolio in covered call funds and rely upon them exclusively. In my opinion, the only place for a covered call fund in a portfolio is for an income solution. If you're buying it as a total return investment, not a good deal. A lot of people think that they can buy these funds and just compound the dividends. You will be sorry in the long run if that's what you're doing. You are so much better off to buy the underlying index and compound the dividends, even though they're smaller, on the index, whether it's the S&P 500, the NASDAQ, whatever it may be. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.